All right, so let's proceed with our paper. Question 11. The diagram shows the demand curve for a firm's product. Which diagram shows the shape of the firm's total revenue curve? And this is in fact very similar to a question that we did in this paper before. It's going to be this, and what was that question? I believe it was something. It was we just did do something very similar. Yeah, it was question 7. If you want to look back at the explanation I offered there, but the idea here is because price is fixed, whatever change in output that you're going to get, um, right? It's gonna have a proportional change in revenue if our because the total revenue is price into quantity. So if let's say output increases by 10%, total revenue will increase by 10%. And that is shown, that means that these are directly proportional, which is shown by a straight line through the origin in the revenue output curve. Because clearly, if this increases by, let's say, 10%, then you want total revenue to also increase by 10%, which is shown here. 12. The diagram shows a firm in a monopoly producing OQ units. Okay, so you're producing here, which output can be observed in the diagram. Now, if you look at here, so it is the monopoly is producing at MC is equal MR is equals to MC, whatever, like MC is equals to MR. So that is normally your profit maximizing output. However, if you are undergoing a loss, it can also be called your loss minimizing output, because it's clear that you'd be minimizing loss when on the same point where you would theoretically be maximizing profit. Now here I think believe the reason you can pick that option is because if you look at the average total cost curve, it's above your average revenue curve. Your demand curve is your average revenue curve. Remember that. So this particular area is your this vertical distance is your per unit loss, because this is greater than your average revenue at that particular point. So instead of a profit maximizing point, you can call it a profit loss minimizing point. Profit satisficing would be when your average cost ATC was equals to average revenue. That isn't happening. Revenue maximization happens when MR is equals to 0. Unit cost minimization. Unit cost minimization, so cost minimization basically, right? So that's when ATC or AC, whatever you want to call it, when that is at its minimum point. So like this would be unit cost minimization. That's not happening. 13. Which figure of oligopoly being assumed when the demand curve for an individual firm is shown? Okay, so this kind of shows price rigidity, and I believe the answer is this. So what I'm looking for in the options right now, I'm looking for something that explains how if you increase prices above this particular price, you don't really what do you say? You lose out on market share because quantity decreases sharply as the other firms do not follow. So since they do not follow your rise in price, a lot of your customers will switch to them. If you decrease prices, you don't get a sharp increase in quantity, so it's not really worth it. And hence you have an inelastic demand curve segment, because your rivals follow the price cut, and hence not a lot of consumers are attracted to you, because the other firms are doing the same thing. They're also reducing price. Now that is not price discrimination. That is not really leadership. I would say leadership is where your price leadership model is different, where your dominant firm sets the price and everyone follows it. So I wouldn't say it's leadership. It's definitely not collusion here, because this is non-collusive behavior where they're in fact competing with each other. It could be explained by interdependence, because this shows how there is a degree of interdependence, and you have to be aware of your rival's actions. You can't simply price independently of it. You can't just go alone. There are costs to going alone. That's the idea, which is why it is better to stick at this particular price, reinforcing price rigidity. So because there's not you can't independently price, at least not without consequences, thus showing interdependence. So that's C. Which statement is most likely to explain why a government decides to increase the highest rates of tax on personal income? It Okay. Why would the government increase the highest rates of tax on personal income? It expects total tax revenue to be unaffected by the policy change. Well, if so, then why are you increasing it? You would only increase tax if you wanted, with regards to tax revenue, if you wanted the tax revenue to increase, right? If it's unaffected, then what difference does it make to you? It is concerned about the possible emigration by some high earning individuals. Well, if you tax them more, they will emigrate. Emigration is like outward immigration, outward migration. A very cheap way to remember this is export migration, E, or import migration for immigration. But whatever, but if you don't want people to leave, then why would you tax them more? C, it regards equity considerations as being more important than efficiency ones, probably because the highest rates of tax, the highest rates are are usually applicable on the really rich, right? Because of progressive taxation. So highest rates are only going to be applicable on the really rich. Now, if you increase those, what you're doing, you're basically taxing the really rich. If you're taxing the really rich, what do? You get additional revenue, which you then spend on the poor, and hence that basically makes the distribution of income more fair, more equitable. It wishes to switch the emphasis of the tax system from direct to indirect. No, in fact, there is more emphasis on the direct tax system because personal income tax on personal income, that is income tax, is a form of direct tax. It is a direct tax, and since you're increasing this, what you're basically doing that you're increasing the emphasis of the tax system on direct taxes, not on indirect taxes. So it's literally the reverse of what D is saying. The Lorenz curve in the diagram shows different distributions of income and of wealth. Um, Percentage of income or percentage of wealth. Yeah, exactly. So, whoops. Income in a country is more equally distributed than wealth. So, know that the more you deviate from this line, this is like, if you're at this line, this is like perfect equality. However, the more you deviate from it, the more inequality there is. So think of it like this: that 4 signifies more inequality than, let's say, 1 would do. So you can think of it like that. So the more you deviate from this particular line. In a period, the distribution of income becomes more unequal, but the distribution of wealth becomes more equal. So wealth is clearly going towards the line. So, and this is more unequal to going outwards, basically, because the more out you go, the more you deviate from the line. One can say you become there's more inequality. Anyhow, which movements would show the effects of these changes on the distribution of income and wealth within the country? So income is becoming more unequal, which means it has to go like outwards. So 1 to 2 works, 2 to 1 does not work, 3 to 4 works, 4 to 3 does not work. So you're left with these 2 options. And if you look at wealth, it's supposed to go towards the line, it's supposed to go inwards. So 4 to 3 works. And what is the other option? C. Yeah, 2 to 1 also works. Now, the reason you can the logic you're going to use to pick between A and C is because it's the first line, basically. So let's look at this in blue. That income in a country is more equally distributed than wealth. So clearly, income needs to start off at a point where it was more equally distributed. 1 is a point of more equal distribution because it's closer than 4. It's closer to the line. It deviates less from the line than 4, which is why you have to pick A. Picking C would be wrong because then C shows that income starts off with curve 3 and wealth starts off with curve 2. That can't happen because curve 2 is more equal than curve 3. And here it's clearly stated that income has to be more equal than wealth starting off. So there you go. That's why you can pick A. A government wishes to discourage tax avoidance. Which policy to achieve this would be an example of the behavioral approach of nudge theory? Like, kind of literally, they kind of already hinted to you what nudge theory is. So, nudge theory, looking at positive reinforcement, looking at incentives, looking at it providing information as to why tax avoidance is such a big of a problem. So, basically, all the non-interventionist measures. So really interventionist measures aren't in nudge theory. Nudge theory is just all about just giving a nudge, like rather than just throwing the person or pushing them. Think of it like that. So like non-interventionist behavioral measures. Um, Compelling direct. Okay, so let's look at the options. Compelling direct tax deduction by employers. Compelling direct tax deduction. Well, no, if you're asking employers to, well, discouraging tax avoidance. Now if you decrease, if you have deductions in direct taxes, if that's what they're trying to say, if you're decreasing tax, normally, as we see by the Laffer curve, that does discourage tax avoidance. I'm not too sure if it's an example of nudge theory. I don't see how you're using a behavioral approach here. So let's keep A on hold for now. B, making random inspections. No, if you're making inspections, you're being interventionist. That's not nudge theory. Nudge theory is being non-interventionist. Providing information on how tax is spent by the government, and that's typical. That is nudge theory, because you're basically letting people know how we spend this money and like how important it is, basically. So you should be you're basically here. You're like encouraging, uh, incur. Well, I don't leave that, but the idea is you're basically encouraging them to pay tax. Penalties and all are, you're being interventionist once more. So no, that's not it. So it's clearly C. The reason why it's not A is because if you have deductions of direct taxes, if you have deduction, what are they trying to say by deduction is the question here. So I looked it up a bit. It's not well, it's not something that you need to know, but a little complicated. But the idea here is it basically reduces the amount of income on which tax is applicable. However, one could say, as we see by the Laffer curve, that when you reduce, either your tax rate, or when you reduce perhaps the amount of income that tax is applicable, meaning making tax less of a burden, that does reduce avoidance, that does discourage, it does in a way discourage tax avoidance, because you're like, okay, it's not as much as it was before, might as well pay it. However, that's not an example of nudge theory, which is why we'll not do A. Okay, so 17, you have demand supply conditions in a particular labor market. When the market is in equilibrium, and the market is in equilibrium here, right? Because when supply is equals to demand. So there you go. Which areas measure the economic rent and transfer earnings received by employees? Okay, so your transfer earnings are basically going to be the minimum amount that they need to pay the employees to keep them in the particular uh, profession. So that is basically your reservation price or your supply price. So look at all points here. So kind of like all of this stuff. This area is your transfer earnings, and obviously anything above your transfer earnings that you're paid, that is going to be your economic rent. So economic rent is JML, transfer earnings is OKLJ. There you go. 18. In 2005, a company drilling for oil wished to reduce its workforce because of a fall in the price of oil. The workers' trade union opposed the proposal, which situation would have helped the trade union in negotiations. So basically, which situation would help the trade union negotiate and basically keep the jobs of the workers. So you usually get a very common question in your paper 4 about how can a trade union increase wage rate without increasing unemployment. So you have to look at a similar situation here. So if capital and labor are close substitutes, that wouldn't help the trade union, because the company would just would can very easily substitute labor in favor of capital. So the company doesn't really need labor that much, so that wouldn't help the trade union. It's easier to fire labor then. The cost of labor had been a small percentage of total cost. Well, that could help, because that means that this is basically it is wage inelastic, meaning that mm, meaning that an increase or decrease in wages wouldn't have that big of an effect in with regards to the amount of labor that is employed. However, I'm not too sure if it helps here, because here it's not an increase or decrease in the wage. That's the reason for the reduction in the workforce. It's the fall in price, which basically is going to decrease your MRP anyways. So probably not this one. The demand for oil had been price inelastic. Well, if the demand for oil is price inelastic and you have a fall in price, well, then that doesn't help either, because if you decrease price in an inelastic case, um, well, then you basically your total revenue decreases. If it had been elastic and there was a fall in price, then maybe it would still have been fine. There had been a large supply of labor, so I don't see how a large supply of labor would help the trade union, because, well, if there's a large supply of labor, that normally means, and like if there's normally so much of something, it normally means it's the well, I don't think you need to link it to this with wage elasticity of supply, but I don't. But there's no link, right? If there's a large supply of labor, how does that help the trade union at all? Um, the company can still very well reduce the workforce, reduce the amount of labor it's employed. Doesn't really affect it. So I think we would go back to our option of B, because, well, all other options have been crossed out. Because think of it like this: if the cost of labor is a small percentage of total cost, then kind of this is very similar to when we used to study about factors that affected elasticity, where we studied if the expense on the particular product was a small proportion of overall income or overall expenditure, then it was inelastic. Kind of like the same idea here. So if it's a very small percentage of total cost, then it's fine. And even if that cost is still exists, uh, it really doesn't matter that much to the company. Like it really doesn't care that much. Okay, if it's such a small percentage of my total cost, that I'm really not going to be caring or looking at you that much, which gives the trade union some sort of leverage, because then obviously then what's the comparative? It's if they're okay, these are the labor, they're a very small percentage of my total cost, they don't really affect me that much now. I could fire them, and then I could have like strikes and industrial action. So obviously, just keeping that labor, even if they're incurring a little cost towards you, that cost for you is really like not that much. It's really something you can very easily deal with, which is why you can go with B. 19, which policy is specifically designed to reduce the level of structural unemployment? So again, structural unemployment is basically where, perhaps due to the economy undergoing structural changes or demand shifts changes, the skills of some workers aren't going to be required anymore, and until they retrain, they're going to be unemployed. That is structural unemployment. Okay, so how do you reduce this? An increase in the level of state benefits paid to the unemployed? No. How do you need to, again, understand that this is because of, their skills are no longer required. So you basically need to find some way of retraining them, of ensuring that they do have the skills that are required in the current state of the economy. So that would be the provision of retraining schemes. Let's look at the other options. We've already crossed out A. If you reduce interest rates, reducing interest rates would perhaps reduce other forms of unemployment, because it is an expansionary policy. But structural unemployment for is part of your non-accelerating inflation rate of unemployment, NERU, your natural rate. So your natural rate can only be held by supply side policies. It can't be held by right by both of these things. In fact, B and C are both fiscal policies. You can't affect your natural rate through fiscal policies, only by supply side policies. Okay, so what is typically associated with a relatively low level of income per capita in a country? So you have a low level of income per head in a country. So you wouldn't have a low population, because if it's national income upon your population, that's how you calculate income per capita. So you would want a high level of population to ensure that the entire fraction goes down. Um, so perhaps low investment could be a possibility. You would probably have high inflation, because the idea is you normally have this stuff in developing countries. So developing countries normally do struggle with inflation. A lot of developing countries, Zimbabwe, Venezuela, have high rates of inflation. We have very, very high rates of inflation. So you can cancel out B and D. You're left with low exports and low investment, and you have to find out what is typically associated. Now, a lot of developing countries, they do have low, they have, well, they do export, but they don't normally earn a lot from their exports, because, well, that's something that's also associated. Because if you look at your overall national income, if you link this with aggregate demand or aggregate expenditure, whatever, that is C plus I plus G plus X minus M. So either a low exports or low investment, both of them would lead to a relatively low level of income. That is for sure. So, but you have to figure out which one is more, is more relevant to the question, which one is typically associated. Now, a lot of these developing countries still do export, but they just import a lot as well, which is kind of why this fraction, this bracket goes negative. um, Investment is a very important supply side policy. A lot of these countries they don't have the infrastructure available for such investments, and investment is much more serious of an issue than exports, and unfortunately it is prevalent in a lot of these developing countries. So while both can be associated, I'd say low investment is more typical. uh, these countries, these developing countries, they still do export. Pakistan exports cotton, textile, a lot of stuff, right? They still do export. They just have unsteady export earnings. Because they normally are exporting primary goods of the primary sector, or if they do export, they just import so much that they kind of offset whatever they exported, whatever benefit that they reaped from exports. So we're all good so far. So these 10 questions were also marked correctly. So that's it for this video. We'll see you in the next one to finish off this paper for the last 10 questions.